All right, we're back with Expandable. Another great episode. This is kind of fun. We did this before, and I wanted to do another loan or no loan. You're in the business of doing commercial loans. These. And I want to give you a scenario, and you tell me if you would, approve the loan.
Okay.
All right. So we've got a software company. All right. They build software for clients, so development work. And they also sell their own software as a subscription. So software as a service.
SaaS, okay.
Right now they have, hopefully I got my numbers here right. They have about $2 million in revenue annually. They're about 3 years old. The founder is the CEO. And they have about $2 million in debt from their startup and spending on sales and marketing efforts. Event parties, conferences, just doing everything out of the gate. Their team is distributed around the world. They have 8 full-time employees. And they want to buy a building for their home base and then also lease out some of the other units. So they want to get something that's bigger than what they need, because right now they're operating out of the founder's home office, headquarters, but a distributed team. But he's thinking, okay, we'll invest, in a building, and we'll get some space, and some of the people that are local can come into the office. We'll have a spot, and then we'll lease out the other offices until we grow. And if we grow, then we can fill up the rest of the building. That's kind of his thinking. Last year they lost $100,000.
Of course they did.
Right.
Startup.
Yeah. But they're projected to grow by $1 million in revenue this year. 80% of that will come from builds, so software builds.
Okay.
And 20% from new subscriptions to their software as a service. And if they do grow by $1 million, this would make them profitable for the first time. So profitable inside of 4 years. Cash flow is unpredictable due to the build projects. Sometimes you have big projects. Sometimes you don't have any projects. I'm trying to hold myself back from going into too much detail here.
I'm listening because I'm waiting more and more because I've got plenty of more questions because,
only $400,000, I say only $400,000 in reserves. Any other financials that you need to know? That I don't know if I could give you.
Cost of the
made up scenario.
Building.
The cost of the building. Good question.
So they have $400,000 in their bank account.
Yeah. So I'd say the cost of the building is, since we're in and near Orlando, this company based in Orlando, they want to buy a building in Maitland, and the cost of the building is $2.6 million.
Oh, that's a hell no.
Okay, so why?
I mean, listen, the typical, bank, we're looking at real estate. There's no ability to repay that. So far, there is no track record of income. So, banks are looking for collateral. We're getting a rate of return, right now being, February 2023.
Yeah.
It's going to be high 6s, at least, really 7%, 8% commercial loan rates. So that sounds like a lot just because we were used to zero interest rates for so long. Mm-hmm. That's really not a huge amount to where you can easily get, 4.5% just having your money in overnight funds. So banks can do nothing and earn 4.5% to 5%. So we're going to take on double that on a risk on a company that has lost $100,000 last year. It's still not proven, So there's got to be. When I get audited by, FDIC or the state and they see a loan write-up on that one, they're going to say, what the hell are you doing? That's automatically like a grade 5. There's no...
Now, are you the primary concern for you is the cash flow and debt?
Well, they haven't proven the ability to repay yet.
Okay.
That's...
So if let's say the cost of the building wasn't 2.6, it was $800,000.
Okay, I'm thinking they're going to be in more in the $400,000 range, $500,000.
Okay. So it'd have to come way down.
They have to come way down, and for a typical community bank is going to they're not familiar with software as a service lending. Mm-hmm. So one thing on this is going to have to go back to is who are they selling to? Who are their customers? How strong are they? Because maybe, if they've got a subscription base, we can look at securing the receivables on what's paying back. Mm-hmm. That would be probably the angle that I would look at on this. And, that's going to be a much higher. So in a scenario to this, they're going to be looking at possible receivable financing, but that's a much faster payback than a real estate that's going to be looking on 20-year amortization. Yeah. So, I mean, really, you know what? You don't need a huff of space. You need to prove yourself. You need to prove your business is making money. Don't go out there and put on debt. So that's, you're jumping the gun.
So then this would be a good scenario for you to advise them, prudently. This is not the time to buy a building.
You need to go and
keep building.
If you want to bring your group together, and that's the reason you want office building is to have more cohesive because you're always working on teams or anything to go back together. That's a good product to be in a work share place.
Just rent.
Oh heck, if you bank with me, we'll let you use our office in our Lake Mary building. Because
until you're ready, and then we'll help you get a building. So you said, knowing how to bank software as a service. So there's a different way that you're going to bank a company that's software as a service versus someone who builds software. It seems like.
There's different ways that you securitize your future cash flows. Yeah. Where you could analyze the projections and way you could build a payback. Software as a service, because then you can look at you've got a new company. You start out the house, the owner of the company, unless, they were successful in the past and they've got a nest egg of assets. That's the thing. I mean, where this could go is, maybe they have several other companies that are extremely profitable and they're making money off of other investments and, but from what you're telling me on that scenario, then yes, it's no. That's what they're living off of is this company. They lost $100,000 last year.
Okay. So to the point of banking them as a SaaS company versus a development company, if the scenario played out where they're 80% of the revenue is coming from development and 20% is coming from SaaS subscriptions, does it matter? Like, how would you think about it?
Well, in the SaaS, then you could look at, you sold the software service, every year, every month, we're going to get payments from so-and-so. So depending on their quality and runway that they are going to, they got 400,000, lost 100,000. So let's assume you got 4 years of runway if everything stayed the same. Well, how strong are the people that are paying that monthly subscription? Mm-hmm. So you can almost underwrite those companies because those are the ones paying back the services. They've locked in. How long is that contract for the software as service?
Okay.
If it's a 1-year contract, they pay monthly. You would look at a discount of that. So you get paid back monthly at a discount. So if it's a year's service, maybe it's 10 months, you're paid off.
Okay. Yeah. I like that. Okay. Mm-hmm. So the advice then, the answer would be no.
Yeah.
And the advice would be,
let's be profitable first before you go out and take on debt. Record. Come on. You've already $2 million in the hole. Maybe an assumption on that is, that was,
it's part investment. And
they just wrote investment and part debt,
So then what?
That they'll have to convert
if they're sitting having this conversation with you and they're saying, okay, we get it. We're cool. We can be patient. What does profitable look like to you? What we get over that hump? Profitability is profitability.
I mean, the way to break it in, if you want to borrow an additional $2 million, I mean, take that on a commercial real estate, $2 million. What's going to be your monthly payment on that plus property taxes and insurance, and make sure profitability is at minimum 25% greater than that. So if it's going to cost, $100,000 a year, you better have 125 up and above that.
Okay.
But then in general too, that founder, are they paying themselves a salary too? They got to be able to take care of their other obligations, their house and everything. So you can look at that. Assuming that they're getting paid, say they're W-2ing themselves, $100K a year, it's covering their house, they're able to support their personal lifestyle off of that W-2, then the business is going to have to be minimum 25% greater than the obligations at a minimum. Yeah. But when they're first starting out, better be higher, better have longer runway. Yeah. I
mean, I know this kind of makes me think of EBITDA. Like it does, as a banker and you're looking to lend, I know you're looking at all the financials and you're looking at all the context too, but do you weight EBITDA more than you would other numbers up the
I mean, to
spreadsheet?
me, I don't even use that term EBITDA. I think people that throw that out are like, oh, my EBITDA is this. What's your net income?
Yeah.
What
Okay.
are you taking home?
Mhm.
And, of course, tax returns can show one number, but it also added in a lot of depreciation expense.
Yeah. Yeah.
So maybe they had a capital expense, they're able to depreciate that in 1 year and they're not going to have a recurring. So, you look at the true cash flow,
Yeah.
you look at what they're taking home at the end of the day and seeing, and especially software service, I would want to look at repeat buyers, if it's the same thing, what are they happy with and going forward.
So number one financial statement you're looking at as a banker's cash flow statement,
Yes.
and then you're looking at pro forma.
Yes.
Okay.
But really,
Balance sheet.
when you're looking at it as a tech startup, that's kind of thing. That's why they take on investors and debts because, risk versus reward. Banks, their reward is much smaller. They're looking at, 8%, 7%. If you hit it out of the park, they're not making greater than that 8%.
Right.
That's fixed.
That's right.
So it's got to look at risk or reward and what is the collateral at the end of the day. And that is, to this day, I mean, the prime rate is 7.5%, and overnight funds are paying 4.5 to 5%. So, to get that extra 300 basis points for non-proven, it's not worth it's not worth a bank to take that risk. It's just not.
Right.
They can take smaller risks in that regards, but yeah, all day long, our regulators would chew us up for that, and rightfully so.
Yeah.
So when they're in that position, they're going to be looking at, either higher interest rate lenders that are coming in, they can afford to do that are, are not insured by the FDIC, or, they're going to be taking on and liquidating their ownership.
Right. Yep. Investors or private lenders. It makes sense.
Correct. And, a lot of times, you may have to give up ownership to not take on that debt, but to give away future profit and ownership. So,
yeah. So no loan.
No.
All right. Maybe next time.
Yeah.
So if you're enjoying this on YouTube or in the Facebook, wherever you're watching this, especially on YouTube, hit subscribe and start commenting, because we hope that we're creating content that is going to keep you coming back. Yeah. Short, bite-sized stuff that's hopefully you're learning something from and getting some wisdom from. And what we want is you to engage with us, right? So if you
give
haven't,
us your loan scenarios. What are your questions? At what point to go to a bank for financing?
Yeah. Leave it, personal details out of it. Just make it, generalized. But yeah, put that in the comments, because
please do not.
We want to see what you're thinking about, and we'll respond.
Yeah.
And then if it's, we think it's, good enough, we'll bring it on the show, and I'll ask Ryan.
Yeah.
Because I'm the one looking at the comments. So, all right.